Morning student, Dr. A. Radhakrishnan, Assistant Professor, PG Research Department of Commerce, St.Joseph College of Arts and Science, Autonomous, Cuddalore. Today's subject, the Financial Accounting 2, Unit 4, Admission of Partnership. Definition of partnership. Partnership is the relation between persons who have agreed to share the profit of a business carried and by all or any one of them acting for all. Partnership deed is an agreement between the partners of a firm that outlines the terms and conditions of partnership among the partners. It specifies the various terms such as profit, loss, sharings, salary, interest on capital, drawings, admission of new partner, etc. in order to bring clearly to the partners. Partnership deed. Partnership deed is an agreement between the partners of a firm that outline the terms and conditions of partnership among the partners. It specifies the various terms such as profit, loss, sharing, salary, interest and capital, drawings, admission of new partner, etc. in order to bring clearly to the partners. 1. Admission of new partner, retirement of partner, death of partner. The admission of new partner, when the time of admission or join the new partner in the partnership firm, the various adjustment or the following adjustment. The following adjustment are necessary when new partner admitted in the firm. First one is recording the capital of new partner. Second, calculation of new profit sharing ratio and sacrificing ratio. Third, revaluation of assets and liabilities. Fourth, transfer of accumulated profit and loss. And fifth one is treatment of goodwill. Now, the problem solving. After that five transaction, the solving the problems. First, journal entries. Second, preparation of revaluation account. Third, preparation of partnership capital account. Fourth, preparation of balance sheet. Now the first one is the journal entries. When the value of assets are increased, the asset account debtor to revaluation account. When the values of the assets are reduced, revaluation account debtor to asset account. When the value of the liabilities are increased, revaluation account debtor to liabilities account. And fourth journal entry is when the value of the liabilities are reduced, liabilities account debtor to revaluation account. And fifth journal entries for profit and revaluation, revaluation account debtor to old partners capital account. And fifth one for revaluation loss, old partners capital account debtor to revaluation account. So maximum compulsory that following sixth journal entries is calculation for the admission of partnership. The revaluation of assets and liabilities. For profit items, A. Increase in the value of assets. B. Unrecorded assets are recorded. C. Decrease in the amount of liabilities. Concerned assets account debtor. Concerned liabilities account debtor to revaluation account. When the revaluation of assets and liabilities for the purpose of admission of the partners. For loss items, decrease in the value of assets, increase in the amount of liabilities, unrecorded liabilities are recorded, new liabilities created, at the time create the journal entries, revaluation account debtor to concern asset account to concern liabilities account. The model of revaluation or format of revaluation account, and the debit side and credit side. The debit side put the amount to asset. The asset value decrease for any asset value, the debit side. Liabilities of increasing value and the debit side. The credit side, by asset increase the value, any asset value increased put the credit side. By liabilities, the decreased of liabilities value put the credit side. Any loss of revaluation account as a divide the old partner and the credit side. But the same time revaluation create the revaluation profit or raising the revaluation profit, so the divide the old partner and the profit sharing ratio, the amount is showing for the debit side. Then if profit or loss, first the profit, we are put the journal entries, revaluation account debtor to partners capital account. If loss, partners capital account debtor to revaluation account. The transfer of accumulated profit and reserves. First the balance sheet. Liability side, whatever the profit, create the profit and loss account and the liability side. At the same time, any give the general reserve in the liability side. And the asset side, loss. The profit and loss account, put the amount to the asset side. Let's finish the balance. Next, the transfer of accumulated profit. Profit and loss account debtor, general reserve account debtor to old partners capital account, being transfer of accumulated profit. And B, the transfer of accumulated loss, old partners capital account debtor to profit and loss account, being the transfer of accumulated loss. And then transfer of goodwill, treatment of goodwill. First one is the simple profit method or average profit method. The simple profit method or average profit method. In this method, profit or some pay years, preferred 3 to 5 years, are added, and this total is divided by the number of years whose profit have been added, and thus the average profit is found out. The average profit is multiplied by the number of years in which the anticipated profit will be available to arrive at the value of goodwill. The format of the goodwill treatment in the simple profit method or average profit method. Goodwill is equal to average profit into number of years purchase. So then average profit is equal to total profit divided by number of years. Finally, we are calculating for goodwill in the method of average or simple profit. And next method of weighted average method. The weighted average method of goodwill is computed by assigning weight to the profit of the previous year. More weightage is given to recent profit and loss weightage for older profits. The profit of the previous years are multiplied with the weights assigned, and then average is found through the formula given, the weighted average method. Goodwill is equal to weighted average profit into number of years purchase. So we are weighted average profit already we are calculated. The number of profit of the purchase. The weighted average profit is equal to weighted product divided total weight. Total weight means an 1, 2, 3, 4, 5. The 1, 2, 3, 4, 5 is added, and super profit method. The super profit method means the profit earned by a firm over and above the normal profit earned by the other firms in the same business. It is calculated by deducting from the profit in any year, the interest on capital at market rate and reasonable salary of the proprietor or the partners. Average profit of this compared with the normal yield and the invested capital in the firm. The excess of average profit or normal yield or profit is known as super profit. We are calculated the super profit and the method of goodwill. The format: goodwill is equal to super profit into number of years purchase. So we are calculate the super profit in based the average expected profit minus normal profit. The average expected profit is equal to the capital employed into normal rate of return. The normal profit is equal to capital employed into normal rate of return. At the next, then capitalization method. The capitalization method is equal to, this method is useful when the actual profit is less than normal profit. Update: under this method, the actual profit is divided by the normal rate of profit which can be earned in that particular type of business in order to find out the total amount which should have been invested as capital. This amount is compared with the net asset of the business in order to find out the value of goodwill. In other words, average profit are first capitalized on the basis of normal rate of return, and then excess of this capitalized amount over net asset of the firm is goodwill. The following formula of the capitalization method: the capitalized value or value of total investment. First we are calculate the goodwill is equal to total capitalized value minus net asset capitalized value. The goodwill is equal to total capitalized value minus net asset. The capitalized value is equal to actual profit divided by normal rate of return. The normal rate of return is every one give by the partnership of admission. So the net assets equal to total asset minus liabilities. So the capitalized method we are calculating. So there are four categories of goodwill treatment. So there. Thank you. The next class, next day, the retirement of partnership we will see. Thank you.